Welcome to this channel, Tech Explained by a Real Expert. I'm a software engineer with nearly 20 years of experience, here to make tech simple and accessible for everyone. From expert insights and honest reviews to practical tutorials and the latest tech news, it's all right here. Subscribe for smart, reliable tech content. Like the videos to show support. Comment to share your thoughts or request future topics. Let's build a strong, informed tech community together.
Building wealth through smart stock investing. Investing in stocks can be one of the most effective ways to grow your wealth over time, but it's not just about picking random companies and hoping for the best. A successful stock investor uses clear strategies, manages risk wisely, and stays focused on long-term goals. Whether you're saving for retirement, buying a home, or simply looking to make your money work harder, understanding key investment principles can make a huge difference. This guide breaks down the most important financial strategies for investing in stocks in simple, beginner-friendly terms so you can make smart, confident decisions and build a solid foundation for your financial future. 1. Set clear investment goals. Before you invest, ask yourself, why am I doing this? Common goals: retirement. Saving money now so you can stop working later and still afford your lifestyle. Buying a home. Growing your savings to afford a house in 510 years. Income generation. Making money regularly from your investments, like dividends. Education. Building a fund to pay for school or college later. Why it's important. Each goal has a different time frame and risk level. For example, saving for retirement in 30 years? You can take more risks. Saving for a house in 3 years? You'll want safer investments. 2. Diversification. What it means. Don't put all your eggs in one basket. How to do it. Across industries. Buy stocks from different parts of the economy, like tech, healthcare, energy. Geographically, invest in U.S. and international stocks. Use ETFs or mutual funds. These hold many stocks at once, spreading out your risk. Why it matters. If one company or industry does badly, your whole investment doesn't crash. Other parts of your portfolio may still do well. 3. Dollar cost averaging, DCA. What it means. Invest a fixed amount regularly, like every month, no matter what the stock market is doing. Example. Let's say you invest $200 every month into a stock or ETF. If the price is high, you buy fewer shares. If the price is low, you buy more shares. Why it works. It removes the pressure of timing the market and helps reduce the impact of market ups and downs over time. 4. Value investing. What it means. Buy stocks that seem cheap based on their true value. What to look for. Low PE ratio. This means the stock is cheap compared to how much profit the company makes. Strong balance sheet. The company has low debt and good cash flow. Consistent earnings. The company makes steady profits year after year. Dividends. The company pays some of its profit to shareholders regularly. Why it's smart. You're buying solid companies at a discount and holding them for the long term, like buying something on sale at a store. 5. Growth investing. What it means. Buy stocks of companies that are growing fast, even if they're not cheap. What to look for. Rising sales and profits. Innovative products like new tech, AI, biotech, strong customer growth. Reinvestment. The company puts profits back into growing even more. Why it's exciting. If these companies succeed, their stock prices can grow quickly, but they can also be risky because they're often not yet profitable. 6. Understand risk tolerance. What it means. Know how much risk, ups and downs you can handle without panicking. Ask yourself, how would you feel if your investment dropped 20? Can you leave your money invested for many years? Do you have other income sources? Why it's personal. Everyone is different. Younger investors can usually take more risk because they have time to recover. Older investors might want safer choices. 7. Rebalance portfolio regularly. What it means. Adjust your investments back to your target mix. Example, you want 70 stocks and 30 bonds. Over time, stocks grow faster and now make up 80. Rebalancing means selling some stocks and buying bonds to get back to 7,030. Why it helps. Keeps your risk in check and stops your portfolio from drifting too far from your plan. 8. Stay educated. Follow the news. What it means. Learn about the economy and your investments. Keep up with company news, earnings reports, product launches, interest rates set by central banks, economic trends, inflation, job reports. Why it's useful. You make better decisions when you understand what's happening in the world and how it affects your money, but don't overreact to daily news. 9. Consider tax efficiency, what it means. Be smart about how much tax you pay on your investments. Tips. Use retirement accounts like IRAs or 401ks to avoid or delay taxes. Put high dividend or frequently traded stocks in tax-advantaged accounts. Use tax loss harvesting. Sell losing investments to cancel out taxes from winners. Why it helps. Keeping more of your profits means faster growth over time. 10. Use technical analysis. Optional. What it means. Use charts and patterns to decide when to buy or sell a stock. Common tools. RSI, Relative Strength Index, tells if a stock is overbought or oversold. Moving averages help show the trend over time. Support and resistance, price levels where the stock tends to stop falling or rising. Why use it? If you like more active trading, technical analysis helps spot entry-exit points, but it's not perfect and works best with experience. 11. Have an exit strategy. What it means. Know ahead of time when and why you'll sell a stock. Examples. Sell if a stock hits a target price. Take profits. Sell if the company's fundamentals get worse. Cut losses. Reallocate if your financial goals or risk tolerance change. Why it's smart. Avoids emotional decisions and helps you stay disciplined, especially during big market moves. Conclusion. Invest with purpose. Grow with confidence. Investing in stocks doesn't have to be overwhelming or risky if you approach it with the right mindset and strategies. By setting clear goals, staying diversified, managing your risk, and staying informed, you give yourself a strong chance to build wealth steadily over time. Whether you're focused on long-term growth, steady income, or financial independence, the key is to stay patient, disciplined, and consistent. Remember, you don't need to be perfect to succeed at investing. You just need a solid plan, the willingness to learn, and the courage to stick with it even when the market gets bumpy. Start small, stay committed, and let your money grow with purpose.
Thanks for watching. I really appreciate you taking the time to check out my video. If you enjoyed it, don't forget to like, comment, and subscribe for more content. Your support means the world to me and helps the channel grow. Stay tuned for more videos, and let me know in the comments what you'd like to see next. See you in the next one.